Tax-conscious investments. A study conducted by the United States Trust revealed that more than half of wealthy investors agree that investment decisions that factor in tax implications are better than those pursuing higher returns, regardless of the tax implications. At the end of the day, what counts is the net pay, and that's how much you're actually getting after taxes. Besides, no one wants their money tangled up in tax problems. Poor tax management on your investment can result in losing as much as 40% of your gains every year. A wise investor will make sure that doesn't happen. When getting into investing and investment options, research the tax implications on the investment product you're in. Make sure your returns are safe and won't be minimized by poor management. For example, investors can invest their retirement savings in tax-advanced plans, like in a 401k, Roth IRA, or put their money in a flexible spending account. When you're informed on investing and financial management, you'll be looking out for poor tax management and implications on your investment. 4. Saving strategy in your financial plan. Investing is a necessary step to become wealthy. As you begin this journey, don't forget the importance of having a saving strategy. Wealthy investors are wise in understanding a financial plan as a dual strategy. This means they are investing and saving wisely. This results in the wealthy investors focusing their time and energy on increasing their inflow of cash and minimizing their cash outflows, hence increased comprehensive wealth. It would be hard to think that wealthy investors are good savers, considering they live in wealth. But they know living below their means will make them achieve their desired level of wealth in the shortest amount of time. Unfortunately, this isn't seen in other low net worth investors or someone poor. Sometimes poor people poorly spend more than they earn, thus ruining their saving strategies. This in turn affects their investment goals and strategies, when overspending can easily be avoided to reach your goals. 3. Investing in both public and private markets. Wealthy people and ultra-wealthy investors understand that substantial wealth is generated from the private markets, as opposed to common or public markets. Wealthy investors will gain a huge amount of their wealth from private businesses, through business ownership, or being an angel investor via private equity. Top endowments like those run at Stanford and Yale use private equity investments to generate high returns. It also adds to fund diversification. It's all about taking calculated risks. Both public and private investment markets have their risks and their benefits. But this is what wealthy investors do differently from low net worth investors. They take the risk, and it pays off, and usually very well. It's important to do your research so you don't lose your money when the business's growth isn't as expected. 2. Not investing only in tangible assets. The first thing people think about when it comes to investing and investing strategies is bonds and stocks. These type of investments are good, but you need to have a foolproof portfolio of different investments, and not a portfolio that only has these assets. The wealthy and the ultra-wealthy investors understand one thing. They know the value and risks that come with owning non-liquid assets. Thus, they carefully ensure proper legal frameworks and allocation of their finances accordingly. You'll find them investing in assets like private and commercial real estate, gold, artwork, and land. And in their portfolios, real estate is a favorite asset class. Owning different assets balances the volatility of stocks. It's important to invest in physical assets, but small investors shy away due to a lack of liquidity and higher investment price point, which is understandable. But when you see wealthy people wisely investing in these physical assets, then maybe you should be as well. In any investment portfolio, the wealthy and ultra-wealthy own illiquid assets, some of which could be uncorrelated with the market, but happen to be useful in their investment portfolio. The good thing is that these assets aren't susceptible to drastic market changes, and when you look at them long-term, they do pay off. Let me give an example. Between June 2006 and June 2016, Yale's endowment fund implemented a strategy which included uncorrelated physical assets, and they returned an average of 8.1% per year between those periods. 1. Investing in emerging markets. The perception is that developed countries like the United States and those in the European Union offer the greatest investment return and security. As a result, you'll find that the majority of people invest in already developed countries. While there's nothing wrong with this, the greatest opportunities lie beyond the borders, and that's precisely where the wealthy look for high-yielding opportunities. Some top countries that the wealthy are currently investing in are Chile, Singapore, and Indonesia. As an investor, it's important to do your research on these emerging markets, just as the ultra-wealthy investors do. When doing your research, make important decisions on whether these markets fit your investment portfolios and your comprehensive investment strategies. Emerging markets are risky, but remember, the higher the risk, the higher the returns. It's understandable that your current needs matter. Everyone's circumstances are different, and therefore, not everyone can do this. But get this, understand money, investing, and the difference between a needs and wants, and you will be on your way to accumulating wealth like the wealthy.